If I, if
Say
I
that. What's the
can.
subject?
We're going to talk about the government and how it provides life insurance. So there's four different variations, or what's the when you got a four letter, what's it called? And well, when you got letters and it does anyway. SGLI,
Acronym.
Acronym.
four different acronyms. Thanks, guys. SGLI, which we'll start out with, and then we're going to look at FEGLI, and then we're going to look at VEGLI, VEGLI. So there's the four different acronyms you got to know. And just understanding and using the right terminology is key when you're talking to clients. So starting out, SGLI, what does SGLI stand for? Anybody want to volunteer?
Group Life Insurance.
Service members, employee group life insurance.
SGLI is just Service Member Group Life Insurance.
Yep.
So,
Yep.
so let's talk about that, and then let's look at um, and by the way, if you look at the three, SGLI is the best.
Yeah.
And there's a reason for that. And it makes a lot of logical sense that we provide as a society and the government a really good benefit for service members to get coverage in the event they are killed in action. And they even have a piece that's called traumatic injury protection, which is built into that. So if you look at their SGLI premium rates, a $500,000 is $25 a month. If you notice too, that's irregardless of age. So if the person is 18 years old or they're 28 or 38, if they're in the military and they're serving, they're going to get a $500,000 in coverage for either just basically, let's say 26 bucks. They're all going to sign up for the full plan. So it's $26 and they get a $500,000 in a death benefit. And then they have some traumatic injury protection. And I don't know if it goes into it. My traumatic injury protection uh, pays service members who qualify injury to help them with expenses connected to their recovery and rehabilitation. If you experience traumatic injury while serving the military, find out if you're eligible for TSGLI and am I eligible. So there's information about that there. But the main thing is knowing you get $500,000 in coverage. And I don't know of anybody that elects for the smaller amounts, but I mean, you can elect for as little as 50,000. I think that would be ludicrous. But most people that I've run into get the max, they get the $500,000. And I don't know if that's somebody when they're signing up, probably saying, hey, just check the box and get the max coverage. I do not know that option. Do they give them, a checkbox? But most of the people I've run into, it used to be 400,000, but they've increased it for inflation, so it's a $500,000. So that's Servicemen Group Life Insurance. And by the way, if you just Google it, SGLI, you want to go to the Veterans Affairs Department, U.S. Department of Veterans Affairs, and go look up the numbers and go look up the facts on that. So, because it's all there. So just take your time and go look that up. The other
Gordon,
thing,
Gordon, I think it's mandatory that they have one of them. Is that true? They have to have at least the lowest.
not really sure on mandatory. I think that would make sense. Certainly would make sense that they would have that. Now, whether did I? Yeah, I did. Okay. So yeah, that's that for the SGLI. One thing to know internally, if you're, we got to know internal and external. External is the SGLI. Internally, we have limitations on what we can write. So if you've ever done this before, I've seen people write up a life app and then it get kicked back. And it's because there's limitations on how much coverage you can write, knowing that they have SGLI. And here's the limitations on that. Military guidelines out of our life operations manual in our own, the company is if they're E1, E3, and I think that's basically people starting out. I don't know what that title is, but some of you might know better what they call those guys. But E1 through E3, the max coverage they can get is 300,000. And then I think E4, E6 is like sergeants, masters. I don't know what that's E4 to E6 is up to a $500,000. E7 through E9 up to $750,000, and then all officers, all ages, up to a maximum of 1.5. You're dealing with an officer in the military. So anybody enlisted, which is the E categories or below, 750 is the max. Officers up to a maximum 1.5 million. Um, so you can look that up, but that's also two things I would suggest everybody know. There's a max amount you can write, and then number two, the SGLI is very affordable, and everybody probably is signed up for it when they get in the military. Any questions on the SGLI? Now, what does it do when you leave is when we get into VGLI, and it will tell you in here what it does. But we'll get into that towards the end of the training today. But SGLI, any questions on SGLI? All right, well, easy enough. So that's SGLI out of the way.
The only thing on the SGLI when somebody pass away, it takes few months for the
The claim
beneficiary to get the
process.
money. Yeah, it took
Okay.
it took like probably 3 months on my case. So usually it takes a little bit longer.
Okay. So be prepared for long wait times on that.
Yeah,
But the
it's
money's
not a
coming,
quick process.
and they're probably going to pay, but you just got to
They
take.
do pay, but it
Yeah,
takes a while.
I'm being kind of silly. They're going. Yeah, not probably. They're going to pay. Um, so yeah, so that's the SGLI program. Good program. And like I said, there's a reason for that because it's the military. We need to take care of our military. So you can go look those
Is
up.
I have a question.
Yeah.
And this might be for Yvette or somebody that's has experience with the military. Is there like does the military take care of burial and so forth right away? And this is an
Yes,
issue?
yes,
Okay.
yes. That's
What I thought.
something that they assign someone and then you make the arrangements.
Yeah.
Yeah, they pay for the funeral, but you know, yeah.
What do you mean right away, Allison?
Like they don't have to wait the 3 months. So like if somebody in the military passes away, the military is going to take care of their burial. You don't have to wait the 3 months.
No, in my case, I had to pay for everything, and then when the money came, I had to pay everybody. And
Okay.
if the person want to be buried in Arlington, there's a long waiting list.
That was
Got
my
it.
point. There's actually a hierarchy, a prioritizing of burial times, like killed in action people. So sorry, people
It's a
killed
little
in action
faster.
are
Yes.
faster, and but anyway, and
Got it.
we didn't have to pay. We told the funeral home he's military, and they just said no problem. We'll work directly with the military, and we didn't have to pay anything out of pocket to be reimbursed. That was
Okay. Here, because he
Yes,
died here, I had to pay, but because I buried him back home,
ah,
the
okay.
military burial was back home, and everything was taken care of.
I understand.
Got
When
it.
I got home, everything was already taken care of. So.
Spousal coverage, since we're there, and this is also on the main site. Active duty service member, does the spouse get an option? And they do. Looks like it's up to $100,000, and then that goes into their 5-year renewable option. I don't remember seeing that years ago. I don't know if that's been added in the last 20 years, but the spousal plan is up to a maximum of 100,000. But if you notice the chart, they use the same chart that they would use in FEGLI and those other types. It's a 5-year renewable term, and under 35 is $4 for 100,000. Then it goes up to 470. So what is that? About a 20% increase in 5 years, and then it goes up to 620, which is larger than a 20% increase. And then it goes up to 850. So it slowly increases in cost up to 1350 at age 50. And then up to $23 at age 55 and 59 and then up to 40. So there is a spousal option too, but usually it's not going to be enough to raise a family or take care of children. When it used to be recommended minimum guideline was to have $250,000 on a non-working spouse, if they could afford to not, be working. So there is an SGLI that has a spousal benefit. So, and that's all over here on the options on the left-hand side. The next thing to look at is OPM. We're going to get into FEGLI, and I just look up FEGLI and I just say, okay, what are we going to do here? And it takes us right to OPM. And OPM is Office of Personnel Management. It's a good thing to keep this tab handy because when you are talking in we're in the Maryland DC corridor. There's a lot of federal employees, so being well versed on this calculator, where to find it, and being able to talk to people is nice. It'll allow you to put in, some basics. Let's say we're going to do this with John, and let's say John's pay with the federal government's 90,000, and his age is 40, and he gets paid biweekly. They all do. And if they sign up for option A, which is their basic, and if they get their max multiplier, which is B, and then their family max multiplier, um, we'll see what the cost of that looks like. And it asks you to click yes twice for whatever reason. So it wants to make sure if they're a postal employee or not. In this case, we're going to say no. So this would tell us how much coverage John can get at 90,000 in income. And at 90,000 in income, his coverage is almost 600,000. And we did the 5 times multiplier on the spouse rider, which was option C. The spouse can get up to family. I think I called it spouse, but option C is for the family. So spouse and children. And 5 times multiplier, the children get 2,500, the spouse gets 5,000. So that would mean 25,000 and 12,500. And it shows you the cost per pay period is 28.52 plus the $1.85 for the family option C. And so the person's paying about $30, a little bit more than $30 a month, or $30 a pay, which is going to be the equivalent of about $70 a month because times 26 divided by 12. And you come down here and you look at it and go, what's the basic? The basic is their salary plus 2. It's a $14. There is an extra benefit, which is something everybody needs to pay attention to because the extra benefit will show you a chart that'll show you that over that next 5-year period, because the extra benefit disappears at age 45. So if they're in their 20s or 30s, they have a decreasing benefit. That's the extra benefit that's added in, and it will go away at 45.
So that 1472 is per pay, correct? Not
Yeah, we're looking at cost per pay
Okay.
period right there. Yep.
so it's about $30.
Yeah, if I said different, I apologize, but that's cost per pay period. The extra benefit goes away at age 45, so they have a decreasing piece. Their total basic when added together at age 40 is 138,000 in this illustration, and they'll show you down here the basic of 92 plus the 46 extra, which is 50% of that amount. And option A, standard coverage. That's one that that's kind of the best benefit, in my opinion, of the entire program because that'll go into retirement. Option A.
60, age 65, right?
Into retirement. So they can take that into their retirement years, past retirement, past 65, Jay.
They all end though.
Yeah.
Option B, additional, I think what is it? Starts decreasing, Denise, over time.
The A and B decrease. I mean,
Yeah.
so the basic
You're
and
talking
the
about in
A
retirement after they leave.
after retirement
Yeah.
it decreases in 3.5 years, and then the multiply decreases in 4 years, 16 days.
Okay. And that was recently we were online with somebody going through that. Optional B is the biggest benefit they get, the 5 times multiplied times their income.
Hold on, Denise, can you repeat that again, please?
So what happens is that they can take it all into retirement, the basic and the optional and the standard.
Mhm.
But at 65 in retirement, it all becomes free. They don't pay anything for it. Even if they had a 5 times multiplier, that goes into retirement with them. But the basic, like his 92,000 and the 10,000 at the age of 65. Now, if they retire before 65, they still have to pay for it. But in retirement at 65, it becomes free and they don't pay for it. But it starts decreasing every month. So the basic and
What is
the,
decreasing the face amount?
the face amount, yes.
Okay.
Because
That's-
they're not paying anything for it. Remember,
That's
it's
what's
free
called a
after the age of 65.
Is that
So
what the
it-
reduction is?
That's the reduction.
Okay.
So it decreases if they have full reduction, which they don't pay for full reduction, which
Yeah.
means there's no payment for it. So it reduces down to zero. I mean, the basic and the standard does not reduce to zero. I'm not sure what that 92 would reduce to. They'll show it down there somewhere. But my persons that I had, hers was going to reduce to 26,000. And then actually it would have been 36,000 or 39,000. And and she would have that forever with no payment.
Yeah.
That 29 or 30,000. But the multiplier reduces, they can keep that. They can take that into retirement.
Yeah.
If they're 65, they will pay nothing for it.
They
But
just
it
gotta, they'll
reduces-
continue to pay the one after retirement.
They don't pay anything
Oh,
in
wow.
retirement. If they're 65.
Okay.
If they're 65. So they can take the multiplier into retirement. If they retire before 65, they will pay for it. But at
We'll come back to that.
65, it becomes free. I actually have that, Gordon, if you want me to pull it up.
Do they get 5 times their coverage free in retirement?
Let's look
That's
after
right.
we get through the basics of it, because it looks like there's a calculator at the bottom here. So
Right.
maybe let's play around with that and dig in a little bit
I
more.
did. I can pull it up and just show it to you because I took pictures of it like that.
Okay. So in this case, I'm going to share with you an Excel sheet, but let's do this first, and then let's go to that option in retirement so we kind of know both. And then the last thing we'll do is VGLI, which will kind of wrap it up. But if you notice, here's a couple things about this enrollee detailed report that I like to just make sure the client knows. They got 598,000. Their cost per pay period is 28.52. Seems certainly reasonable. If you do the math, if you do 20 at 40 years of age, 28.52 times 26. This is where you got to know math. So 26 pay periods, which is every 2 weeks.
5704.
And then you divide it by 12. Thank you very much. No, 6179 is what I got. 6179. So I did multiply by 26 divided by 12. So
It's
62.
not really just 2 pay periods a month. It's more than that.
Yeah, it's 26.
Oh, that's
why I
right.
said times 26 divided by 12.
Mm-hmm.
So $62 a month. And yeah, and then anytime I always, you see AD&D, my thing is I always tell people, look, it's great. You're going to have AD&D at Navy Federal Credit Union if you're military. You're going to have AD&D at almost every bank in America offers AD&D. You know why so many places offer AD&D and it's cheap and it's free?
Never happens.
Because it hardly ever pays. That's why. So the idea behind AD&D is you would have to be killed in an auto accident on a Sunday afternoon in the zip code of 21136. Because if it was 21137, they don't pay. So it's got to be just in the certain guidelines. And I'm joking about that.
Above.
Yeah,
and it's got to be on a pretty sunny day at 70 degrees, because if it's raining, I joke about it, but here's the reality of it, Jay. In the event you're in a car accident, let's say that is really catastrophic, and then they air vac you, they put you in one of these helicopters that comes in and lands, and then they take you to the hospital, and you die the following day, because they can keep you alive, but you die the following day. You died the following day at the hospital, not because of the accident. And in the corner, it says you died because of cardiac arrest. You're better off when they get there saying, hey, don't take me to the hospital. I don't want the chance to live. I want to die because I have AD&D.
Just pull the plug on
Oh
me
my
now.
goodness.
So
Don't
if
ever
you're
plug
gonna
in.
if you're gonna play that game, then count on it. But if you're not gonna play that game, which is ludicrous, the odds of you dying in an accident are slim to none. Fair enough?
Fair enough.
So, and then sometimes you'll see in life policies where they'll say, what's it? They'll say common carrier, which means you're on an airplane or something like that. So let's just not play that game. Let's just look at real coverage. What are you paying for? So we're going to make an evaluation based on that. Your basic life insurance. So this is where they get the basic. What is that? It's 92,000. They've got this extra benefit that they're giving you a little bit more coverage when you're younger, right? So in this case, it's 46,000 at age 40, but next year it's going to get down to 37,000. Next year, 27,000, and then it's going to go away at 45. So I call that decreasing term. So really your basic coverage is 92. If you didn't know that, it's good to know that. Employees under age 55 at no additional cost. This extra benefit doubles the amount of basic life insurance if you're age 35 or younger. Beginning on your 36th birthday, the extra benefit decreases by 10% a year. So for that next 10 years, it's going down.
What? That's terrible.
Option A, this is the 10,000. Now, if you notice, it's a 5-year renewable term. It doubles in price in the next 5 years. So at year 40, it's going to go to 60 cents. Then it's going to go to $1. It's not a doubling, but it's a pretty good jump. Then it's going to go to $1.80, and it's going to go to $6, which is almost triple. So it levels out at age 60, and that's for the standard benefit. And if that one also can be going into retirement, that's why I tell people keep option A. That's nice. But option B is really, really expensive.
Yeah.
And if you understand logically why, hopefully everybody at the end of today's training will get why. Why do they do it this way? Because Jay, let's say you and I enroll in the military and you're a non-smoker, you're a runner, you're a health nut, you eat only organic. But I come in at the same time and I like Marlboros, I like whiskey, and I like, doing stupid things and I jump out of airplanes more than you and I do side stuff on a motorcycle and I race things. We're paying the same price. Okay. I'm smoking a cigarette, I'm drinking whiskey, and you're over there going, Gordon, you're going to kill yourself. You're going to die. And you're out for a jog and you're eating, granola and blueberries. And I'm going, I'm eating McDonald's every day.
Right.
We pay the same price. So there's no benefit through any group policy
Right.
if they're going to give you the coverage for the same price equally.
Plus nothing.
They can't give Jay preferred rates. And so Jay and I are paying the same thing. So that's why it's priced this way. So Jay can do all the right things, but he's going to pay a price because he's grouped in with me, Mr. Unhealthy. So you want to understand that. And when people, they get it, oh, okay, the dime's got to drop somewhere. Why in the world would the military I got the greatest benefits in the world, or federal job, right? I took a job with Social Security. My mama told me I'd never be fired, and heck, I don't even have to show up half the time. I'm locked in because I've had people tell me, oh, they'll never be fired. Oh, that person's guaranteed. Really?
Yeah, right.
That changed in the last decade. But bottom line is you're paying more. And if you notice, option B is 1350. It doubles, goes to 27. It's going to almost double again. That's doubling again, right? Yeah, 54, almost. So it just goes up and up and up. There's big jumps in price. And at some point, you look at, if you're still working, that option B coverage is going to be $216, but that's times 26 divided by 12. So that's $468 a month here. So it's just going up and up and up, up and up and up.
Yeah. It's not going to be affordable after a while.
Yeah.
That's
And it even goes up for the option C coverage down here, $185. That's for your family, $265, $415, $665. So we're going to look at that in a comparison and then forget the AD&D. But 5-year renewable term is what everybody has. 5-year renewable term, unless you're SGLI. FEGLI is 5-year renewable term. Okay. So is VEGLI, VEGLI. So
Hey, Gordon,
goes up in price. Yep.
when they get the raises so that the cost of that increases also.
Yep.
When the employee
Yeah, they have
getting the raises because their insurance is
So
going
it's a
up.
5 times multiplier. Yep.
Yeah, it also goes up with the same thing.
Yep.
Yes.
So that it's not actual number, but it's you can calculate at that point.
Yeah.
For all these employees,
This
dude,
is
there's
this is
so
Coverage
low.
goes up too. Yeah.
This is what gets me right here. I know I sent this in the leaders group, but it says on this one that we're looking at, option B additional, the amount of option B insurance is from 1 to 5 times an employee's salary at the time of retirement, effective April 24th, 1999 or later. Annuitants with option B coverage are eligible to make an option B reduction election at the time of retirement.
We're going to
Yes.
look at that in a
Option
minute with
choices are
Denise.
full reduction.
Yeah, we're gonna look at that.
We're going to look at
We're
that.
talking about current first. Right.
Yeah, let's stick to the current active employee for now. So this is a comparison I did, and I'd suggest you all figure out a way to do this. Even if you don't do uh, Excel, figure out a way to do it because you want to look at total cost. Even if you draw it on a sheet of paper and you go out and you say, hey, this person's 40, and let's say they got a $500,000 in coverage through the federal government. Their cost was $24. So when you're comparing that and you're pulling up rates that are standard rates with us at $73, some of you guys give up and go, well, this is not going to work. There's no way I'm going to show them this because my standard rate is $73 for the same coverage that this person has working for the government, right? That's triple in cost. But Jay, what you do is you look at the future and you say, hey, what's it going to be for the next 25 years? If I quote them a 25-year term for $73, let's look at our cost. Ours is $875 a year. I don't know when I did this. This could be a little old. I don't recall, but 72.92. I'll tell you in a second. No, it's current. So this is because I was going to say, is this a discounted rated annual? No, but it's the current system that we're in. But in this case, it's $875 a year where they're paying $292. So you would lose if you're just looking at price in that year. But if you look at over the next 25 years, our program would cost them $22,751 down here in that 25-year period. If they stay where they're at, because nobody talks to them, nobody gets involved in their life, nobody challenges them and says, look, I know it's inexpensive now, but look at what happens at age 45. You're up to 49. Look at what happens at age 50. You're up to 81. Look at what happens at age 55. You're up to 146. And if you wait and you're still employed and you're still working, which so many people are with the government, and they're at 60 years of age, which is still young, you're paying $325 a month. Okay. And that's when it starts to get painful. And even here, people start noticing in their 50s, they're like, okay, this is starting to get expensive. And then you start to you hear about people complaining about the life insurance. Where's my paycheck going? Well, good chunks going to your life insurance. And this is just for them, not the family. So, and at age 65, it would be $390 a month. Whereas with us, it's still $73 a month at age 65. Okay. So some people would say, Jay, well, I'm going to get really smart. This guy I'm talking to, I'm going to wait till I'm 50 and then I'm going to come back and see you. You know, that would be good. And I would tell clients this. I do tell them. I'd say, hey, I've had clients try to outsmart the system and say, well, I'm going to wait till I'm 49 and do this. Well, here's the problem with that. You're 40 now. 9 years from now, do you think you're going to be healthier? I mean, or is there potential in the next 9 years to get a doctor appointment that says, hey, you've got hypertension, or you've put on a little bit of weight sitting behind that desk. Now you've got some health issue and you're on multiple prescriptions. Is that possible for a lot of people in their 40s as they go into their 50s?
For sure.
Extremely
Statistics say that we don't get healthier as we get older.
You don't get healthier. Now you could. There's some anomalies. There's some times in people's lives where they change their health and they lose weight. I understand that. I get that. But the odds are against you. So you can wait. And the other problem with waiting is this rate that we're showing here. I'm showing you that today at 40.
Yeah.
If we jump back on and we say, hey, what's the rate at 49? It's no longer 72.92. You know, I don't know what that is, but it's not pretty. I might pull it up and show them, but it might be $100. Why? Actuarial speaking, your cost, you're closer to dying. So you're buying it and locking it in at age 40 here, not at 49 or 50. So you're gambling if you think, well, I'll wait till later. You can take that gamble.
Now.
So the question is, do you want to gamble or do you want to just say, hey, I think if we can do it now, this might be the best time? Because check this out. Let's say you do it now and we get your preferred rates.
Yeah.
You look good. You look healthy. I mean, you look like you might qualify. If I can get your preferred rates, because remember the story, Jay, you and I'm a smoker. I'm drinking whiskey. I'm eating at McDonald's. You're eating fruit. You're walking, running, eating healthy. It ain't the same. So that adds up. But right now, if you can get that preferred rate, you're going to get a great plan, and it's almost, I mean, crap, look at the difference. But now watch this, 25 years. Let's say you lock in preferred with us, and it's 47. Over the next 25 years, you'll pay $14,561. With your federal plan, you'll pay $42,000. So if we can get you the preferred rate, Jay, I'm going to save you almost $28,000.
I'll take that all day.
And worst case, Jay, if we get you standard rate, I'm still going to save you about 20,000 bucks. So Jay, if I can save you between 20 and 30,000, $28,000, is it worth trying?
Definitely.
So Jay,
Definitely worth it.
wouldn't it make sense if we applied and just see what we can get you?
Yeah, as soon as possible.
Soon as possible, whether it's COD or cash or whatever, or money right now, I don't care.
Yeah.
But wouldn't it make sense to go ahead and let's get the process started? So in just a few minutes, we'll start that.
Yeah.
Fair? Okay.
Love it. And they see the importance in them saving money over time, and they could be investing that money, then investing that 20,000 over a 25-year period. Psst,
Yeah,
man, that's an opportunity of financial freedom right there.
that is. These are just other comparisons I've run over the years. I always like to run comparisons just to see what the options are. There is a contractor out there, SAIC, that does a similar type of thing, but they also, you guys ever heard of SAIC? Yeah.
SAIC, I'm familiar with it. I've heard of it.
Yeah, I forget what it stands for. It's another one of those military acronyms, but it's a contractor that I've run into a couple times, and they have same type of thing. So I had to run one where our coverage, and this guy applied for it.
Also, right? Sorry.
I think Wilbur was the client that found it, but theirs is going to be $374 a month, and we took the application because he was paying $332. But I was like, look, dude, we're going to save you almost $50,000 over the next 15 years if you apply with our coverage, and they did. So, but harder to get it at 55 than it is at the younger age. So, almost all the contractors around the military. So, I'll stop there for a minute. Who else does this apply to? DC government. Because if you ever run into people that are DC government, the DC government copies OPM. It's not the same. It's not federal. They have their own. But if you go look at their DC government site, it's almost the same site. So all DC employees, state capitol police, all these people that work for the District of Columbia, state police. Another thing I would suggest when you start getting into police officers, years ago, we found out that the Baltimore City Police Department would pay out like $500,000 to all of their active duty police officers. But the key was the term active duty. So if they were being killed while they were off duty, or if they died of heart attacks off duty, they don't pay. So that's a great benefit while you're on duty. If you get into a gunfight or somebody takes your life, but a ton of these guys that are, these guys are allowed to carry guns off duty. So they get hired as off duty armed guards. Well, that's where people get hurt. So that's where their highest risk career is when they're off duty carrying a weapon and protecting an establishment or a business or a function or a synagogue or a church or those types of things. Does that make sense?
That's Maryland Police Department also.
Maryland
They cover
Police?
you an hour before and an hour after.
Wow.
You are supposed to be on duty.
Yeah, and you have to look at some fire departments have a similar, not all of them, but a similar scenario where they might provide, like if you die on duty as a firefighter, the coverage might be like $1 million, but if you die off duty, they have some minimal amount.
To me, it's almost like the accidental death and dismemberment. You're gambling on that. And I have seen fundraisers, GoFundMe, families raising funds for a police officer that died because he had a heart attack while playing pickup basketball on a Sunday afternoon and died and left 4 children and a mama, a couple, mamas. But anyway, that ain't good.
Yeah.
So that's why everybody that's wearing a uniform and every federal employee, we got to talk to them. We got to be proud of it. We got to get all over that because you might look and go, oh my gosh, we can't compete. No, we can compete on total cost. And if they can get it, and which I get it, and I think you can convey that. So does that make sense, Beth? Does that make sense? Miguel, guys, why do we want to get in front of these federal employees and service members and police officers? Any questions on that
Yes.
before we move
Awesome.
on?
Can I say something else too about the federal employee? There's a new program, not new, it's old, but it's more well known now called WAEPA, WAEPA.
I've run into it. Yep.
What that is it's a nonprofit that provides group life insurance through New York Life.
Yeah.
So
it's inexpensive too, and
it's very
you
inexpensive.
got to do total cost,
and you got to do a medical too there. So you can get FEGLI without doing a medical. For WAEPA, you have to do a medical, but if you could pass the medical, it's way less expensive than FEGLI. But again, total cost, group life insurance. And then the other thing is these people are losing their jobs. So many federal people have lost their jobs lately. So you get 31 days to convert it into a whole life policy, or else you lose coverage. So these people are short now.
We're going to go into the conversion factors here in a minute, but
So one thing to remember too, though, guys, is that the federal government has the Actively at Work program also. So their FEGLI, their group, has the Actively at Work program, which means if they're out sick, I just looked it up too.
Is it 1 year?
I used to think it was 1 year. I just looked it up right now to read it for the Actively at Work program for federal government. And it
Denise,
doesn't
can you share that?
Can you share that?
What I just looked up?
Yeah, what are you reading?
Oh,
and where it is? Thank you.
I have to be able to share. Can I share?
In 1 second. Now you can. You can now, Denise.
You guys see my screen, actively
Yep.
at work definition?
Yeah.
Yes, ma'am.
So it's the same thing. Consequences is not actively at work. And it tells what the actively at work, they must meet all the following conditions. Effective date of coverage. They are reporting for work at their usual workplace. They are physically able to perform all usual. They are not absent due to sickness, injury, annual leave, sick leave.
I like the consequences at the bottom.
At least they spell that out. Most people don't even spell that out, saying you're absent due to sickness. They just say everything else that you're present for and leave out sickness.
Can you pull it up or go down a little bit for the consequences if not actively at work?
Yeah, there you go.
There we go. If found not to have been actively at work on the designated effective date, insurance benefits are considered never validly enforced and no benefits will be paid. Well, there you go.
Wow.
Gotta be
And it tells
kidding
you
me.
right there, if an original effective date is December 1st and the employee is on leave on November 29th, the last workday, coverage will not start until the employee returns and meets the criteria, possibly on January 1st.
Wow.
Understanding that and then knowing if you work for the federal government, just know the benefits, master the benefits. There's plenty of people and stories in our company where people have made, millions just by mastering their understanding of the benefits where they work so they could in turn teach the people around them. Because if you work, I think in this area, it's an easy market. Hey, if you're a federal employee, reach out to me today. I want to share something with you. That could be a post on social media. If you're a federal employee and this is September is Life Insurance Awareness Month, I'd love to teach you something about FEGLI. If you want to learn more about FEGLI, please reach out to me. I want to jump back real quick because remember we talked about SGLI to start with. One of the things everybody should have available is on POL, there's an access to what's called a military sales booklet. And it's just something you want to know if you're going to deal with military people. I got into this because I got some referrals through a church membership some time ago. And I found myself on Fort Meade or in the community of Fort Meade. Somebody had an appointment. I got on base. I don't know how this was a long time ago. Showed my ID. They called out, said, and then later on, guess what? I found out I wasn't supposed to be on base because they have an approval process and you have to have.
Yeah, you're supposed to get a background check and clearance before they let you on that base.
That changed, I think, at some point in the last 20 years. But I got on base and they have these rules that you have to abide by. So be careful. And if you are meeting military people, personnel, best thing you could do is if they're a military family, is meet them at a restaurant off base nearby. So don't go ever try to get on. I don't even know if you can anymore,
I used to
but
work on the base, and I had my phone out. I was recording the tank in this unit. They pulled up on me. They're like, "Yeah, we got to confiscate your phone. We got to clear your data. You're not supposed to be recording anything on this base. You know you're not supposed to have your phone out or nothing like that." I was like, "What?"
crazy. Crazy, crazy. Well, let's do VGLI and let's do the piece with Denise because talking about what happens when you leave. Because I think, understanding the conversion, because you want to educate these folks. What happens when I leave? So let's look at VGLI and then we'll come back to Denise's piece because some of that's very new to me. U.S. Veterans Life Insurance. That's military. Whoops.
Hi,
Uh,
Gordon. Hi,
yeah.
Gordon. Christian is on.
Okay. I didn't know that. Hey,
You
Christian.
just got on.
I think
Okay.
one thing that's really
Good
important.
morning, guys.
Good morning.
What's up,
Good
Cap?
morning.
I think something that's really
Fascinating.
important about this, SGLI and VGLI is a lot of these people get out of the military and they're disabled, right? And then they can't get any other insurance. So while they're in the military, they're not
There we go.
disabled still. They're working so they can get normal insurance while they're in there. And then when they get out, their only option is really VGLI because that's what it's for, is for the people that, because they can't get approved for anything else. So
Yes, sir.
I think it's important that when they're like, oh, I got coverage and I got this coming out, it's like, yeah, you do, but I don't know what percentage of people leave the military disabled, but it's not a small one.
Well, when you leave an employer, in law, they have this thing called COBRA. And
Yeah.
COBRA is a legal thing that says, hey, if I'm insured, I'm allowed to take insurance with me, but that doesn't mean the price stays the same. All that says is I can keep it. Well, the military and the federal employees have that same thing with Veterans Group Life. You have the right, and it tells you in here how long you have. You have VGLI within 1 year and 120 days of leaving the military. So this is military. But you look at what it does. It comes down here and it's 5 year renewable term. So it goes up every 5 years. And what Matt is saying is true. We've got people working with us. We've got people, they leave the military and they might have left because of a disability.
Mm-hmm.
They're probably going to be relegated to VGLI, which is 5 year renewable term. It's going to go up every 5 years. 45-year-old is going to pay $95 for $500,000. And then the following 5 years, he's going to pay $145. And then at 55, he's going to pay $250. So it's not the same as level term. Then it goes up to $425. And then it gets to the point where, guess what? Because some people on here, and I'm going to let Denise and I kind of finish it up with a conversion option. But I think we all need to understand this. Life insurance wasn't designed for people in their 70s and 80s. Does it pay? Yeah, sometimes, but it's hardly ever sold to people in their 70s or 80s. And if it is, it's graded premium term. Why? Every actuary and insurance company operates with the same actuarial table. And that means, what does that mean? They don't have a special actuarial table to their other company. It costs the insurance company more money to reinsure a 70-year-old than it does a 40-year-old. So when we get people to the end of term, I know there's people that'll criticize Primerica and say, well, if you didn't get them to invest, you got them in a bad situation. What do you mean? The actuarial table's the same at your company, Joker. So don't tell me that we do some disservice. No, I think we do a service all the time because we keep you in the most efficient product your whole life, which is term insurance. And yes, it's going to cost more. I never back down from that when I'm in an end of term situation with a client. The client's upset. I stay calm. I'm sorry you're upset, but the reality is you're older and everybody's paying more. And I apologize. But the whole point of life insurance is to get out of it. It's to rent an estate while you build an estate. So in our last few minutes, let's go into that conversion, Denise, because you had a little bit more knowledge than I did on that. Can you share that real quick?
Yeah.
Now, this is for a federal employee, correct?
It's a federal employee. She's 65 and she's about to retire. And she really knew that she was paying a whole lot for her optional because she had optional. So her basic is about 106. And right now she's paying $16.96 for it. So her total basic is that. She has the optional for $10, but she also has the multiplier 5 times, which is 520,000. She's paying $249.60 every pay. So she's paying a total of like $590 something
600
a month.
Yeah.
At this point. So her total is $636. Remember, she's 65. So she's paying a total of $590. And she's going to retire actually in a month or so. So what happens at retirement is what we were trying to figure out and do, because she was looking to get insurance right then before then. So she can keep her regular insurance. And she elects the full reduction, which the full reduction is 75%. I mean, no reduction. Yeah, full reduction is 75%. What happens to her insurance at that point is that it begins to decrease immediately the month after, and it decreases every month. So if she keeps it, you see here that 106, in 3 years and 16 days, it will decrease to 26,500. But she pays zero for that. She pays zero because she is 65 and she's in retirement. If she doesn't go into retirement and she's 65, she still pays for it. But if you're in retirement and she's 65, she doesn't pay anything for it. But it will decrease down to that 26,500 in 3 years and 16 days. And then the same thing with standard. If she had it, she can keep it. That standard is also for $0. No dollars. And the reason no dollars is because she's 65. If you went into retirement before 65, you would still pay for it up until 65. So that's 10,000 that it will reduce also immediately, but it will reduce down to 2,500. So in total coverage in 3 years and 12 days that she would have from all of that she had from that basics would be 29,000. Now remember, she had the option. So her thing right now is that she thinks she wants to keep some of the option. She's not real certain, but she wants to keep some of the option because she wants to have more. But if she kept all of the option at a full reduction, because she can. So when you go into retirement, you can choose to keep some of your reduction, some of your multiplier because you had it. If you didn't have it before, you can't keep it. But if you go into retirement, you can keep it. She had 5, so she could take some of no reduction at all, or she could take full reduction. So at full reduction means that whole 520 means it's going to be reducing. So it will reduce down to 0 in 4 years and 12 days. So you see over here, her cost is 0 because she's 65. So she
Why
will
would
have,
someone, if it's 0, why would someone elect to reduce down the amount of coverage they have if they don't have to pay for anything over the next
if it
4
wasn't
years?
0, Allison, I'm going to show you that. If it wasn't 0, if she didn't pick
The
full
full
reduction, she would have to pay for it. So I'm going to show you that.
Okay.
There is an
It's
option.
full reduction. So that's why, right. So she can have this whole 520, but it's going to reduce every month down to 0 in 4 years and 12 days, which simply means that she'll have coverage for that time.
Mhm.
So it won't be that whole 520, but it's reducing as time goes on
By 2% every month until
by
she
2% every month. Right.
Does the payment reduces too?
The
Or just
payment
No, she has
zero.
no payment.
Okay, no payment. Okay.
She's
Denise,
65. The reason
Come
she
on,
has
guys.
no payment is because she's 65
Yes.
and she retired.
Denise,
Yes.
with the 4 years and 12 days, if you add that to the 65, 70, and it won't be there, right?
That's right.
So
Correct.
this other column way over to the right where it has 75, 79, does that mean anything?
Yes, that just means, let's say she had retired at 70. She's 65. This is just showing you what it would have been if you retired. If she retired at 70 and she has 520, then she has 4 years and 12 days after 70.
Right. So that's what it's really saying over here. Like when 80 and over, that means they retired at 80 or something, and then they got it for 4 years and 12
4
days.
years,
Yeah.
that's right.
Okay.
So this is just showing you that because this is on a normal basis, which I'm going to show you, this would increase
Let's
every
look at
5
that.
years.
Let's look at that.
But they're just showing you that it doesn't. So she has 0 there. So the same thing with her 106. First month it reduces to 30, then 2120 after that. That's just full reduction, guys. That's just showing full reduction, which means if she decides to go into retirement and keep all the insurance she has, she can have it all for no cost. But after 4.5 years, she will only have that 29,000. Now remember that basic 29,000 she will keep forever with no cost after 4 years. After 3.5 years with that one.
Yes.
But the thing is that she actually wants to, because we haven't done it yet, I meet with her today, to keep some type of coverage. So I did 2, because we talked about that. So let's say she did the multiplier. We already know she has the 29,000 if she keeps that just basically as no reduction, 0. But let's say that she did, because we talked about 2 times reduction. So her 2 times reduction is her multiplier is 2 times her salary, which was 104. So that means she has 208,000 that she's going to pay for, but she still has full reduction on that 3. Why? Because she's not paying for it anyway.
Okay.
So still for that part of that time, she still has that 312
Starts out
that's
at
going to
520.
end in 4 years and 12 days.
Got it.
But the 2008 is what she's paying for. So she's going to be paying starting off 216.32 for that.
Got it.
And you
That's
see
monthly?
that's monthly. So
And that would
216.
increase after 5 years?
No, well, yes. You see it over here to the right?
Uh-huh.
It's showing how it increases.
Oh, very nice. Okay.
So it increases 216, then 387, then 811, then 1297. If she kept that 2 times multiplier, if she
Got
keeps
it.
that. Now, though, my recommendation, because I did a
Love that.
quote.
Quote.
I
You did a
haven't given
quote.
it to her yet.
I just pulled it up. Yep. That's
My
awesome.
recommendation is 250. And the reason for 250 is because that 2008 costs more than this 250.
Yeah. Price break.
Right. So 250 for her would be 250.21 per month. But it would be $45,000 dollars. Now, if you look here, right now,
85,000.
if she took this, I didn't do the breakdown that Gordon did yet, but I just broke it down on a little bit less on paper. If
Makes
she
sense, though.
actually
Yeah.
did the multiplier with them and pay that 216 and all of those increases over a total of 15 years down here to 80, and probably a little more because this just says 79, but 80. She's going to pay $84,903. But if she got this 250 term policy with us and she's pretty healthy, she would pay 45,000 over that 15 years.
Nice.
And if she decided to do the one-time multiplier with them for us, that would just be 187.50. So I'm showing her both.
Nice. Nice, Denise. Congrats. I love that. I haven't seen that before, but man, that is gold.
Yeah. So if they want to keep coverage in retirement, they can, but they're still going to pay a whole lot more for it. But the big part was that this part is actually free, even though it's reducing down.
Yeah.
And by doing that too, if she goes with you, she'll have 250 through you, and then she'll have
And she
the
take that
5-time multiplier
still have that
over the next
for the
Get that
next
free
4
full
over the
years.
next
reduction.
4.5 years.
For the next
It's a
4.5
higher
years.
amount.
Now,
And
do
you
we
get
this-
that extra.
And you
Yes.
give her a terminal illness benefit rider of $100,000 that she doesn't have.
Yeah.
Let me
That's
share
right.
something with you real quick, and then we're gonna open it up. I think it's nice to see Christian, but good to hear from him. But let me share this with you too, guys. Denise, awesome job. I didn't know that. I'm so glad I showed up today. But if Denise does that and the client makes Denise is going to make $1,300, $1,400 doing that. So ain't that something? And I just ran the quote just to see what she was getting ready to do, and it was funny. She was a step ahead. So that's just, that's the value in being a professional. That's the value in going pro. Understanding FEGLI, understanding Veterans Group Life, understanding SGLI, and don't run away. Get excited because we have a better program if they can qualify for it. And that's not even a preferred rate. That was a standard rate. Denise, she's healthy. There's 65-year-olds that could get preferred. She might only pay $200 and talk about the value. So to me, that's an easy application. Why not try? Not even hesitate. Let's try. Even if it's COD, who cares? Get her to try. And the benefit that we have is at the end of the 10-year term, now she'll be in her 70s, so she doesn't get the custom exchange option at 75, but she can get DT 100. She can pay the same price and decrease the coverage, and it doesn't go every month. It goes every year. It'll decrease. But
she's 65, so she has 15 years.
Oh, you gave her 15s. That's right. So you take her to 80. Denise, great job. Great training today. Hope you guys are better for showing up. I know I am. I didn't know that.
Quick, Denise,
A lot of good
because
stuff.
I'm working on one of these policies now, and I'm probably just gonna have to reach out to you directly because I'm gonna need some additional help. But it says that life insurance approaching age 65 payments. So the basic life insurance payment stops, and then the post-retirement basic life insurance premium continues. Obviously, it's free, but it says that it's coming out of. It says it's taking out of my
pension.
annuity till death.
Yeah, that's their pensions.
That's just their wording.
Yeah. And the annuity, Jay, is this. If she's been with the federal government long enough, they have a pension plan. That's what that is.
Right, that's what that is.
You can
That's
use
their
those
pension
terminologies to interchange pensions, annuities. We ought to have a training one day to talk about that because it's really an annuity is a self-directed pension.
Yeah.
So that's what the terminology. She's got an
So
annuity.
that's what they mean, Jay. It's coming out of her pension payment.
Yep.
Wow.
So it's just like her paycheck. It would be
Yeah.
coming out of her paycheck on a normal basis, but she's not working anymore, so she's getting a pension. So it'll be coming out of her pension payment.
Thank you, Denise.
Thank you, Denise.
Can we hear from Christian real quick?
Yeah, that's what I said. We're done. Christian David, baby, good to see you, man.